The Little Book of Valuation. How to Value a Company, Pick a Stock and Profit. By Aswath Damodaran. This is a book summary. What if I told you that you're watching right now, could learn to value a company just like the Wall Street titans do? No Ivy League degree, no hedge fund experience, no $10,000 Bloomberg Terminal lighting up your office. Just one little book and a curious mind. In today's video, we're diving into The Little Book of Valuation by none other than Professor Aswath Damodaran, the man they call the Dean of Valuation. If Warren Buffett had a classroom, Damodaran would be handing out the syllabus. This book isn't some dry finance textbook locked behind jargon. It's a blueprint, a treasure map, a practical guide to decoding the DNA of any business, big or small. Whether it's a high-flying tech unicorn or a century-old manufacturing firm, Damodaran shows us how to see what a company is really worth, not what the market says it is, but what it should be. So if you've ever felt like investing is just a chaotic game of hype, hashtags and hot takes, buckle up. We're about to swap the noise for knowledge and give you the tools to think like an investor, not a speculator. Let's pull back the curtain on valuation, in plain English, and unlock your inner financial wizard. Chapter 1. The Myth of Just Trust the Market. Picture this, you're at a cocktail party. Everyone's buzzing about the next big thing. Some startup is going to the moon. A biotech firm is disrupting the world. And your cousin just bought 100 shares based on something he saw on Reddit. Sound familiar? Most people treat the stock market like Vegas with better lighting. They don't analyze. They hope. They chase rumors, trends, and TikTok tips, all while ignoring the one question that really matters. What is this company actually worth? Damodaran calls it out for what it is, gambling in a suit. He reminds us of a timeless truth. Price is not value. Just because a stock trades at $200 doesn't mean it's worth $200. And just because the market is excited about a company doesn't mean you should be. The heart of smart investing is valuation, and Damodaran drops a bombshell early in the book. Every asset, yes, every single one, has an intrinsic value. That includes meme stocks, that includes crypto startups, that even includes your local bakery, if you're thinking of buying in. The market may fluctuate, prices might rise and fall with the wind, but underneath all that noise, value remains. The question is, do you know how to find it? Chapter 2, The Toolbox of the Trade. Okay, now imagine you're about to embark on a journey to uncover a company's true worth. You're Indiana Jones, but instead of ancient relics, you're hunting down future cash flows and risk-adjusted returns. Damodaran doesn't send you off empty-handed. He opens the toolkit and says, here, these are your weapons. First up, the time value of money. Because $1 today is worth more than $1 tomorrow. Why? Because you can invest it, grow it, or use it now. If you're comparing today's price to tomorrow's potential profits, you have to adjust for time. Then comes risk. Not all companies are created equal. A stable utility firm isn't the same as a volatile crypto exchange. Damodaran teaches you how to account for that, how to use models like the capital asset pricing model or HIPM to build risk into your valuation. And finally, accounting. No, not the boring kind. The useful kind, the kind that lets you read a balance sheet like a detective at a crime scene. What's real? What's inflated? Where's the cash flow coming from? And what's hiding in the footnotes? In just a few pages, Damodaran hands you a compass, a map, and a flashlight, and says, go, value something. Now this is where it gets fun. In The Little Book of Valuation, Professor Damodaran sets the stage for what he calls the valuation duel of our time. Intrinsic versus relative. It's the battle between science and street smarts, between spreadsheets and sales comps, between what a company should be worth and what others are paying for it. Let's break it down. Intrinsic valuation is like being a scientist in a lab. You're isolating the business, its cash flows, growth expectations, and risks, and running the math to uncover its true DNA. You're asking, if I own this business forever, what would it be worth to me today? Think Warren Buffett in Omaha, calculator in hand, quietly valuing Coca-Cola like it's a family heirloom. Now flip to the other side. Relative valuation is more like being a seasoned real estate agent. You're walking through a neighborhood of businesses, peeking at what the neighbors sold for, and asking, What would buyers be willing to pay for something like this today? This is where you compare Tesla to other automakers or Netflix to other streamers. You lean on price multiples like PE, EB. In fact, the best valuations often blend both. If your intrinsic valuation says a stock is worth $50 and the market is pricing it at $35 and similar companies are all trading above that, that's not just a green light, that's a buy signal glowing like Times Square at midnight. In Damodaran's words, use intrinsic valuation to understand the business and relative valuation to play the game. Together, they sharpen your edge like nothing else. Now buckle up, because this part of the book plays out like a film. Act 1, The Dreamers. These are the fledgling startups. They've got a killer idea, a small but growing customer base, and a whole lot of ambition. But profits? Not yet, maybe not for years. Damodaran says valuing these companies is like forecasting the life of a toddler. You need imagination, tempered with discipline. Here, storytelling meets spreadsheet. Your inputs, like future revenue growth or margins, might be wild guesses, but that's okay, as long as you're honest about your uncertainty. Act 2, The Grown-ups. These are your Apples, your Johnson & Johnsons, businesses with predictable revenues, consistent dividends, and balance sheets that could probably survive a zombie apocalypse. Valuing them is more grounded. You don't need wild forecasts. You need steady, sober math. In Damodaran's words, this is where DCF models shine. Discount the cash flows, estimate terminal value, and boom, you've got a number you can trust. Act 3, The Aging Stars. Once glorious firms now limping along. Think of a legacy media company losing ground to streaming, or a department store stuck in a world of online shopping. These are the trickiest to value. Why? Because they're shrinking, and nobody likes putting a price tag on decline. But Damodaran gives us a lens. Look for realistic reinvestment, assess management effectiveness, and decide if there's a turnaround coming, or just a slow fade. Each stage requires a shift in mindset. You wouldn't value a rocket ship like you'd value a freight train. And that's the brilliance of this section. Damodaran helps you switch lenses as easily as a seasoned cinematographer. Because investing, like filmmaking, is all about seeing the story clearly, before everyone else does. Now, just when you think you've got valuation figured out, Damodaran throws in the curveballs. Because not all businesses fit neatly into your spreadsheets. What about a bank? A startup with zero revenue but a sky-high pitch deck? An oil company sitting on reserves that may or may not ever be tapped? These aren't your standard plug-and-play companies. These are valuation rebels. Damodaran calls them special situations, and they require a different kind of thinking. You can't use cookie-cutter models here. You need a little creativity and a lot of context. For banks and financial institutions, it's not about free cash flow. These businesses run on capital requirements and regulatory nuance. So instead of cash flow forecasting, you zoom in on equity returns and risk exposure. You ask, how safe are their assets? How trustworthy is their leverage? For commodity companies, like oil and gas, it's a roller coaster of volatility. Today's reserves could be tomorrow's jackpot or write-off. That's where Damodaran introduces the concept of real options, the value of flexibility. Just like a startup choosing if and when to scale, oil firms have to decide when to drill, if to expand or whether to shelve projects when prices crash. That optionality, it's not on the balance sheet, but it's valuable. And then there's invisible value, the stuff most analysts overlook. Maybe it's brand equity that doesn't show up on a spreadsheet. Maybe it's a patent portfolio quietly generating royalty gold. Maybe it's an undervalued customer base or a unique algorithm behind a product. Damodaran pushes us to go deeper, beyond numbers and ratios. Because in these special situations, value lives in the nuance, in the stories, in the assumptions others are too lazy to question. These chapters are like a masterclass in thinking differently, where valuation becomes less like accounting and more like investigative journalism. As we come to the end of our journey through the Little Book of Valuation, Damodaran doesn't just close the book, he hands you a compass. His 10 rules for the valuation road aren't just tips, they're principles. Here's the golden one, the rule that echoes through the entire book. Valuation is not about precision. It's about good judgment. Let that sink in. Valuation isn't about building the world's most complex Excel model. It's not about getting the exact right growth rate down to the decimal. It's about making thoughtful, reasonable estimates. and understanding the big picture. It's about being intellectually honest, recognizing your biases, and being willing to say, I don't know, but here's what I think and why. You don't need to be a genius. You don't need to be right all the time. You just need to be less wrong than everyone else, more often than not. So next time someone tells you a stock is going to the moon, take a breath, open your toolkit, and ask the real question. What is this actually worth? Because now you know how to find out. If this breakdown helped demystify valuation for you, go ahead and hit that like button. Subscribe for more deep dives into the world of investing and business strategy. And tell us in the comments, which company do you want to value next? Want to read the Little Book of Valuation for yourself? Just do it. Until next time, keep questioning, keep learning, and above all, keep investing smart.